This analysis report is looking at the 10.5% drop in RZLV AI, that's RZLV, right after they acquired Crownpeak. The core argument is that the market is spooked by the debt, but it's missing a huge revenue transformation.
And it's a powerful argument. The math behind the valuation shift is, it's really compelling. But the delivery, the way it's framed, that's where I think we run into some friction right at the start.
That's exactly where I want to begin. The report's sophisticated financial analysis is undermined by a sensational and, I'd say, aggressive framing that really risks alienating the target investor audience.
Yeah, that's the weakness right there. It's so striking because the analysis is clearly for a professional crowd. We're talking growth investors, traders with a high risk tolerance.
Right. These aren't speculators. They want data, not just hype.
Exactly. So when you see a title like RZLV crashed alert, and then phrases like screaming buy, it just creates this cognitive dissonance.
It does. It makes it feel like an emotional, sort of reactive trade.
Instead of a calculated investment thesis. And that's a shame, because the actual valuation work in the report, calculating that price to sales shift from 160x all the way down to 11x, is incredibly solid.
It's monumental. That professionalism in the numbers needs to set the tone for the entire piece, not just get buried in the middle.
Absolutely. I mean, when the math is that strong, the math is the hook. You don't need the extra flair.
So the suggestion here is pretty straightforward. Align the tone with the data. Let the clarity and logic of that valuation drive the whole presentation. It just adds so much more credibility.
So let's talk about some concrete ways to do that. How do we shift that title from a trade alert to, a piece of measured insight?
Well, you could reframe it to be more descriptive of the actual thesis.
Maybe something like RZLV, assessing the Crownpeak acquisition market reaction. And then a subtitle maybe, a post-merger valuation shift.
I like that. It signals that you've actually done the work to figure out what's going on, rather than just reacting to the panic.
And inside the report, those emotive phrases, they've got to go.
Oh, definitely. I get the enthusiasm, but screaming buy, it sounds like a promotional newsletter.
It really does. And it immediately makes me question the integrity of the analysis, even if the numbers are sound. So instead, use language that actually reflects the risk-reward profile.
Something like a highly asymmetric risk-reward profile.
Yes, or compelling value proposition at current pricing. It still shows conviction, but professionally.
And it fits the argument better. The core case isn't the flash sale. It's a fundamental re-rating based on 10x revenue growth. That's a long-term story.
So you don't need the siren emoji? The urgency is in the numbers, not the punctuation.
Okay, so fixing the presentation is key, but that valuation shift only works if you can calm the market's biggest fear, the debt.
The elephant in the room.
Exactly. The report says they took on $150 million in debt, bringing the total to over $240 million. And it correctly identifies that as the reason for the drop.
Right. It sees that number in a high interest rate world and just hits the sell button. Panics. But the way the report handles that fear, I think it's a bit thin.
I agree. So to make the case truly robust, the analysis of the debt load has to go from just acknowledging the risk to proactively stress testing the company's ability to actually manage it.
That's the weakness. The report identifies the debt load shock, which is great, but then it pivots almost immediately to all the revenue benefits.
It leaves the reader hanging. You're left to do the mental math on the interest payments, and that's where skepticism starts to build.
It really does. We know the company had a $17 million operating loss in the first half of the year before this deal? A skeptic sees that loss, plus $240 million in new debt, and their mind just goes straight to bankruptcy risk.
So you have to dismantle that narrative head on.
The suggestion, then, is to really bolster that section explaining the crash. You need to analyze the specific quantitative impact of the debt. Give the reader the hard numbers.
Okay, so how do we do that? What's the first step?
Start with the gold standard, a hypothetical debt service coverage ratio.
Compare the cash flow they'll have to the payments they need to make.
Exactly. You have the numbers on Crownpeak's profitability. Use them. Show that the combined company can generate enough cash to cover the new interest, hopefully with a good bit of a buffer. That directly tackles the insolvency fear.
That's super specific. I like that. But serviceability is just one part of it. The type of debt matters hugely right now.
Which brings us to the structure of the leverage itself. We need details on the terms. Is it mostly fixed rate? Is it variable? If it's variable, you have to quantify that risk.
Don't just say it's risky. Show the numbers.
Yes. Calculate the estimated quarterly increase in interest expense if rates go up by, say, 100 basis points. You turn this vague fear into a manageable, predictable cost.
And that also helps with the fear from the bear scenario, the idea that the debt just crushes them. That's not just about paying the interest this quarter, it's about having enough runway.
That's the final piece, the maturity schedule. You have to specify the term structure of that $240 million.
Show that the bulk of it isn't due next year.
Right. If you can show that management has, 3 to 5 years before any major payments are due, it completely counters that narrative of an immediate crisis. It frames the debt as a calculated long-term tool for growth.
So we've fixed the tone and we've stress-tested the downside. Now let's get to the fun part, the upside. The whole reason for taking on this risk, the Trojan horse strategy.
I love that phrase. It's so descriptive. You're basically buying access.
Immediate access to Crown Peak's incredible client list. We're talking Unilever, Sephora, Tommy Hilfiger. The plan is to funnel RZLV's AI, their brain commerce, directly to them.
And this is the engine. This is what gets you to that projected $150 million in annual recurring revenue. The entire thesis hangs on this.
It does, which means the analysis needs a dedicated look at the operational complexities, the real-world timeline for actually making that happen.
And that's the weakness right now. The report really minimizes the execution risk. I mean, think about integrating a new piece of AI into a giant like Unilever.
It's not a simple software update.
Not at all. And right now, integration failure is just a single bullet point in the bear scenario at the end. But it's not just a risk, it's the primary operational threat. If you can't cross-sell, the whole thing falls apart.
So we need to turn that potential into a concrete expectation. The suggestion is to add a whole new subsection, focused on the synergy timeline and the actual integration hurdles.
This is where you show the roadmap. First, the timeline. Are we really thinking initial upsells will happen in 6 months?
Or is it more like 18 months, once you factor in enterprise procurement, compliance, technical deployment, all of it?
Investors need a realistic timeline they can track against quarterly reports. Give them milestones. Bridge the gap between the deal closing and the revenue showing up.
And let's talk about the tech itself. Crown Peak has a digital experience platform, the DXP. RZLV is bringing in this AI layer. How do they actually fit together?
That's the critical path. You have to discuss how RZLV's AI integrates into the Crown Peak DXP. Are there technical dependencies? What about client-side challenges?
Like data governance, maybe? Or the need for heavy customization for a client like Sephora?
Exactly. If the new tech requires major changes to their existing IT, that sales cycle just got a lot longer and a lot riskier.
And speaking of sales, integrating the tech is only half of it. You still have to sell it. The report notes investors are worried about the $50 million cash burn.
A very valid concern. If they have to spend a year and a bunch of cash building out a new sales force, that anxiety is only going to grow.
So the analysis needs to address that. Is the current Crown Peak sales team, who are experts at selling DXP, ready and trained to sell a complex AI offering?
Or do you need to hire specialists? If so, that's a new investment, more cash burn, and a potential delay. Showing that management has a clear plan for the sales pipeline, maybe by pointing to pilot programs or new incentives, would directly address that operational risk and help soothe those cash burn fears.
This has been a really necessary deep dive. The foundation of this analysis is so powerful that valuation arbitrage is just sitting there. But these 3 areas are where we can make the thesis totally undeniable.
Absolutely. First, we refine that aggressive tone to match the very sophisticated math, which just boosts credibility.
Then we deepen the stress test on the debt. Use real financial metrics, debt service coverage, maturity schedules, to get ahead of the market's fears.
And finally, we provide a structured, granular analysis of the operational risks. That Trojan horse strategy needs a real, concrete plan behind it.
The report does a fantastic job of pivoting the narrative from a stock at 160x PS to one at a compelling 11x. It's an overnight change.
And by implementing these suggestions, making the language match the math, and stress testing the debt and operational risks with real numbers and timelines, that strong foundation just becomes bulletproof against any skeptical counterargument.
Exactly. The goal is to build the kind of trust and conviction that the detailed valuation work already demands. We really